The Monetary Authority of Singapore is widely expected to tighten monetary policy tomorrow, allowing the Singdollar to strengthen. This is according to 15 of 18 economists polled by Bloomberg. If so, it'll be the first time MAS has adjusted its monetary policy since April 2025. And here's how it's done. Now, generally, MAS manages what's called the Singapore dollar nominal effective exchange rate, or NEER. It tracks the Singapore dollar against a trade-weighted basket of currencies from major trading partners. Now, MAS does not reveal which currencies are in the basket or their weighting. MAS can change the slope, the midpoint, or the width of the band. Making the slope steeper allows the Singdollar to appreciate faster. Changing the midpoint would be the equivalent of a one-off revaluation or appreciation of the Singdollar. Now, narrowing the band keeps the exchange rate more stable. In all, tightening monetary policy helps make imports cheaper, as prices are expected to climb higher. Now, Singapore uses this instead of interest rates to influence the economy, primarily because total trade is more than 3 times its GDP. And for every dollar spent locally, 40 cents goes to imports. In such a small and trade-reliant economy, the exchange rate has a far bigger impact on prices than domestic interest rates. So steering the NEER is the most direct way to keep inflation in check. And for more, we're joined by Song Seng-Woon, who is an economic advisor at SDAX, and Dr. Aurobindo Ghosh, who is Assistant Professor of Finance Education, and he's also the Director of the SMU Financial Literacy, Inclusion and Technology Program. Gentlemen, welcome to the show.
Thank you for having us.
Now, Dr. Ghosh, let's start with you. We know that MAS is widely expected to tighten policy. Do you think this is a preemptive inflation move that also signals that the central bank is quite concerned about imported price shocks?
Absolutely. In fact, you see the uptick in the inflation rate across the board. And part of the reason is the oil price having 20% of the oil that is, and natural gas going to the rest of the world is being impacted by the closure of the Strait of Hormuz. So that is, and there's an expectation that that might, of course, have impact on prices for a lingering period of time. So that's one of the reasons why there's an expectation, 15 out of 18, as you rightly mentioned, economists believe, and very different from a month back, that they expect that MAS will tighten their monetary policy.
Now, Seng-Woon, let's go over to you. We know that oil has now surged above $100 per barrel once again. And if prices stay elevated, how would that change your outlook of Singapore's inflation, its growth, and also MAS's path going forward?
I think, adding to what Prof. Ghosh says, I think we are now looking at prices that may stay elevated for longer, because even if we have the ceasefire tomorrow, miraculously, the infrastructure that for the oil and gas remain damaged. A substantial amount of damage in the Middle East. So prices, Econ 101, supply and demand, unless we're talking about a collapse in demand, that's a different story. We don't want that. So in terms of the supply side being disrupted for longer, it may mean that energy costs stay higher for longer. So the MAS, I think, will be positioning itself not just for the immediate impact of keeping important inflation at bay for as long as possible, but longer than we had experienced any time before as well.
Yeah, and if MAS raises that NEER rate of appreciation, what do you think that is best placed to address? And also, what are the limits of this exchange rate policy?
Well, it's variable. Clearly, it depends on external development. For now, we can say it can be one-off. It's a recentering at a higher level, which therefore means a quite significant appreciation of the Singdollar, say keeping the cost of cabbage import cheaper for now, and it could be longer in terms of if fertilizer costs and transport costs remains elevated for longer, or you further down, if there's still great uncertainty about the actual growth path, you can even widen the policy band to account for a greater degree of uncertainty like we had in the aftermath of the Asian financial crisis. The global financial crisis as a good example, great uncertainty. So we have quite a few options that can use to essentially to anchor inflation and inflation expectation and prices in Singapore.
Yeah. Now, Dr. Gosh, talking about previous crises, right? Compared with 2022, when the central banks were dealing with more post-pandemic inflation, also a bit about the Russian-Ukraine war, what is quite materially different this time around?
Okay, I mean, very important point that the similarity is that there is a supply constraint, a bottleneck in supply, whether it's grains from Ukraine or oil from Russia. Now, at that time, Russian oil was mostly going to Europe, but from the Strait of Hormuz, most of the oil that is coming in is almost 80% is coming to Asia. So that's one of the reasons the impact in Asia might be felt more than what happened then. Now, in general, what happened in 2022 was a reaction to the stimulus payment after post-pandemic. So monetary policy would be kind of greatly suited to sort of quell that particular problem. But in this particular case, where there's literally 20% of the oil and natural gas is taken out of the system, is a little bit more difficult to do the same thing.
Yeah. So, Sing-Wun, how concerned then should policymakers be about stagflation, both in Singapore and globally?
I'll be happy with stagflation because with inflation, there's still growth. My worry is that the worst case scenario of recession, if we were to see employment and job creation being affected by investment decision because prices stay elevated for longer, whether it's for a can of beer or it's for vegetables or just essential daily needs for goods and services, leading to a pullback in consumption and then slow down in growth far more significantly than what we currently is experiencing. So that is a distant possibility. But yes, for now, I would say stagflation, I think most likely near-term outcome. Well, we will just have to wait and see. Stagflation, at least, is still livable. We can have, in that sense, policies and help to manage in terms of high cost of living while there's still employment growth.
Yeah, Dr. Gosh, do you agree with that?
Well, I will beg to differ a little bit because there's this big S stagflation and a lowercase s stagflation. So big S stagflation happened back in the 70s when there was an actual oil shock where growth basically stuttered to a halt and there was significant unemployment. Now, we don't see that much of growth being halted as of now. You know, growth is still going on, you know, right in the range that MAS has been signaling.
Demand, especially, yeah.
So exactly. So that's one of the things. But the thing is that if this persists for a long time, that is going to create problems because people will pull back their consumption. And once they pull back consumption, then the corporations and firms will believe that we don't need as much employment. And that is where things might kind of snowball.
Yeah, this is where we look out for in terms of the monthly PMI survey, which we clearly see businesses a bit more hesitant about hiring because they're wary on the input costs that they're experiencing at the moment. But, you know, that's somewhere that we have to track up on in terms of how that leads to job creation and investment decision in the months to come.
Yeah, and Sing-Wun, speaking of businesses, as you were just mentioning, right, could a stronger Singdollar meaningfully cushion both households and businesses in your book to stimulate the local economy?
To some degree. I mean, we have got vouchers to give up, but fortunately that will help. But again, a lot to do. As Prof was saying, a lot will depend on external demand. Earlier you say trade is 3 times the GDP. So we need demand outside to also create the driver of growth in Singapore, whether it's on the goods sector side or the services side.
Well, Dr. Ghosh, do you think there's a risk that these benefits are felt more in the outbound spending stage than in, let's say, the domestic economy specifically? Right.
I mean, most of the things that we are talking about is locally, it might be good to kind of, give help, whether it's through CDC vouchers or other vouchers being brought forward, is to defray the cost and the impact of inflation. But when you're looking at companies or, firms which are basically export oriented, they are facing, almost a double or triple whammy because their cost of employment will go up in the foreign currency, which they will actually get the prices in. Their, accommodation costs will go up because they are all in Singapore dollar. So indeed, in the short run, I think it's good for the domestic economy to try to support it a little bit more. But if you want to really grow at a faster clip, you need to address something to try to increase, growth rate to some extent.
All right, Dr. Ghosh, Sing-Wun, thank you so much for coming in to share your insights with us. That was Sing-Wun from SDAX and Assistant Professor Aurobindo Ghosh from SMU.